Welcome back to the Video CPA. I'm Michael Scott. I'm your host. I'm a CPA and certified public accountant, certified management accountant. And I've got 45 years of income tax preparation experience and accounting experience. I have a master's degree from Brigham Young University. And today we're going to talk about rental property again. We're just about done with rental property. We're talking about passive activity rules and real estate professionals. And we're also going to hit on the at-risk limitations, at-risk rules today as well. So stay with us. Nice to have you being here. If you haven't subscribed to this channel, please do so and hit the like button. If you like these videos, this is the channel where we talk about tax videos and accounting videos, things about taxes that are of interest to individuals that have to file tax returns, which is almost everyone. So may not be the most interesting subject in the world, but it is something that we're all required to do. So hopefully you appreciate these videos. Let's get into it. The first slide again is our disclaimer for affiliate products. If you hit the link in the description area of this video and go buy something from Amazon or somebody else, we actually get a commission, and we like that. So do that if you're so inclined. Also, the Video CPA educational disclaimer. Try to get everything right. We may miss something once in a while, so you need to do some research as well. All right, passive activity rules and at-risk rules. The at-risk rules actually have to be applied first, so we're going to talk about those first. But both of these rules have stipulations in them that will reduce your loss deduction or eliminate it altogether on rental property. So we haven't really talked about rental losses much. We may have hit it when we talked about expenses, but we did talk about rental revenue, rental expenses, and but we didn't talk about income. I mean, if you have rental income, you claim it, and maybe you get a QBI deduction on it. But when you have a rental loss, can you take the loss? And so let's talk about that, because rental activities are defined as passive activities, and so normally you can't take losses on passive activities unless you've got other passive income to deduct them against. And so that's the situation we have with rental activities. So the at-risk rules we'll talk about first, and they basically say that, hey, you've got to have some skin in the game. You have got to have some money invested here, or you're not going to be able to write off your any of your losses. So you've got to have some income invested before you can write them off. And if you don't have any income invested, they're not going to let you write the losses off. So if you're not allowed to write them off in 1 year and you become invested in the next year so that you're at risk, well then you can take those deductions in the next year. If, however, though, you write some deductions off and then you find out later that you're no longer at risk, well then those deductions can be recaptured. So just be aware of that. So the at-risk rules apply to almost everyone except regular corporations. They do apply to partnerships and S-corps, not to the entities themselves, but to the shareholders and the partners of those entities. So let's go on and talk about passive activity rules. Now the passive activity rules, there's two types of them. The first one is basically someone who owns a business and or shares in the ownership of a business, and it is a trade or business recognized by the IRS, but they don't participate in that business. So they may collect money from it, but they don't participate in it. And in that situation, if there's a loss in that business, they're not going to be able to take that loss because it's considered a passive activity. The second situation is rental real estate activities. And rental real estate activities do not usually allow losses. even if you're a material participant in that activity, it does not generally allow losses. There is one exception to that, and that's a very good exception and allows most people that have rental activities to take some losses. So we'll talk about that in a minute. But these passive activities also apply to most entities, certainly individuals, personal service corporations in this case, closely held corporations, partnerships, and when I say partnerships, that's the owners of those partnerships, okay, and trusts and estates. So almost everybody except regular corporations. All right, let's talk about what the definitions of rental activities are, okay. Rental activities, again, are considered passive. Even with material participation, unless you're a real estate professional. So in this video, we're going to talk about the qualifications needed to be a real estate professional. And not everybody can do that, and you may need to make sure that if you classify yourself as a real estate professional, that you have the documents and the contemporaneous records to back that up, because the IRS may well audit you if you hold yourself out as a real estate professional. Anyway, the exception that I was talking about earlier is a special $25,000 allowance, which allows passive income from rental activity to be applied to non-passive income, or your regular income, and be deducted. So you can deduct up to $25,000 of rental losses against other types of income. Now, that's a great situation. The only stipulation is you have to have active participation in that rental property. So the other stipulation is that it's going to phase out between $100,000 and $150,000 worth of income. So if you're considered a high income earner by the IRS, you may not get this deduction at all, unfortunately. But let's look at how they define active participation. Okay. And then we'll look at the higher level, which is material participation. All right, active participation, if you've got a rental, and unless you have a property manager, you're probably making decisions about that rental as to who's going to repair it, who's going to paint it when it needs painted, who's going to fix the sewer when the sewer needs painted, something done with it. So you're making management decisions, such as approving new tenants, such as deciding on what the rental rate should be, deciding on what the terms of the rent should be, and approving expenditures and contractors that are coming in. If you're doing those things, you've got active participation. And so it's a fairly easy thing to qualify for, unless you've got somebody managing your property and you're not doing anything on it whatsoever, except maybe paying the bills that they tell you to pay and collecting any money that may be earned, or looking at any losses that may result. So that's active participation. Let's look at material participation now. So material participation is a higher threshold, and you can see we got 6 or 7 requirements here. And so you've got to have materially participated in a trade or business or a rental activity, okay? And we're talking about rental activities here. And this means that you've got to have, the first requirement is that you have 500 hours of participation in a rental activity during the year. So if you've only got one property, that might be kind of hard to meet, but 500 hours is quite a few hours. And again, you have to have good records on this. I went to the IRS one time for a doctor. We had fairly good records, but he didn't win the situation. They didn't believe that if you're a doctor and you had just a couple of rentals that you're materially participating in those rentals. And so he did not win that situation. So you've got to have good contemporaneous records on these things, showing what you do, who you pay, how many hours you spend, and how you spend your time. Now, the second one is And you can qualify for under any one of these, actually. Any one of these will qualify you as a material participant. Frankly, it doesn't do you a lot of good to be a material participant over an active participant unless you're a real estate professional. So, let's go over let's go over these though. If the taxpayer provides substantially all of the participation and all of the activity that's done on that rental for the year, he would be a material participant. If in the next one the taxpayer provides over 100 hours during the year and his participation is at least as much as anybody else, he's a material participant. If the activity is a significant participation activity, which some rentals are, and he's got several of these significant participation activities, and he actually provides over 100 hours of service in each one of them, and all of those together add up to over 500 hours for the year, he's a material participant, or a material participant. Okay. And if he has been judged a material participant for 5 out of the last 10 years, he's going to qualify as a material participant. Also, they need to be a participant, you've got to participate on a regular, continuous, and substantial basis. And that will qualify you as a material participant. But again, you have to keep records on all this stuff because if you're audited, you're going to have to prove your position. All right, with that in mind, let's go ahead and look at what a real estate professional has to meet. Okay, so your real estate professionals, first of all, they've got to be engaged in the business of real estate. Okay, they've got to have a trade or business in the business of real estate, and over half of their personal services from all the businesses that they're involved in have to be involved in real estate. So real estate has to be over 50% of all their involvement in any trade or business that they might be involved in. All right, so that's the first situation. The next requirement is that they have to have performed more than 750 hours of services during the year in real property trades or businesses, okay, in which they materially participated in. So the material participation comes in for the real estate professional there. But if you're a realtor running around, if you've got some rental property yourself or something, you're going to do that. If you're a contractor or something building houses. So, I mean, this isn't that hard for people that are in the business. What makes it hard is if you've got 1 or 2 rentals or 3 rentals and you're trying to qualify yourself as a real estate professional, it makes it a little bit more difficult. So what are the benefits of a real estate professional? All right. One of the benefits is that all of the things that you're involved in then, all the rental activities are considered non-passive, and you can write your losses off against other non-passive income. And that's the deal. Okay, so you qualify yourself as a business. If you're a business, the QBI deduction that we've talked about is there for you. A few drawbacks, but the benefits are more than what the drawbacks are. So the last thing we need to look at is what constitutes a real property trade or business, because this is where the 750 hours have to be spent and over 50% of your time. So if he develops or redevelops real property, all right, that's a trade or business. So if he spends 750 hours during the year doing that, and over half of his time is spent doing that, he'll qualify. Constructs or reconstructs property. So if you're doing construction, if you're doing home improvement, repairs, that type of thing, you'll qualify. If you're purchasing property and you're purchasing property on a regular basis throughout the year, you qualify. If you're converting property, maybe from residential property to business property, commercial property, that qualifies you. Somebody that rents or leases property on a continuous basis and has kept good contemporaneous records on these things can qualify. If you operate or manage property as a property manager, you can qualify, and if you're a broker. So real estate agents can usually qualify pretty easily for this stuff because all they do is go around purchasing property and selling property, and they probably got rentals as well. Most of them I know own houses. So those are the things that will qualify you. Those are the types of businesses that you need to spend your time in if you're going to qualify as a real estate professional. Like I say, there are some advantages to being a real estate professional. You can much easier to write off all your expenses because you do have a business. It's much easier to qualify for the QBI deduction, and you get to write off all your losses if you have losses on your real property. Now, if you got losses, you're not going to be able to take the QBI deduction, but you can take it on any properties that you have income on. So that is it for that. And if you want more information on this, go to the Video CPA's Targeted Tax Training. I'm working right now on the actual course that I've got out there that will be marketed to CPAs and real estate professionals, probably insurance professionals. So it will have this in much more detail. I've covered the high points of this in this lesson, but if you want more information on it or more information on any of the videos that we've had on real estate, go out to the Video CPA's Targeted Tax Training at www.thevideocpa.com. And if you haven't subscribed yet, hit the subscription button. Appreciate it and appreciate you listening. Thank you.